Hey there. Hi, it's Neil Christiansen, and welcome back to another episode of the Mile High Market Talk podcast, where we bring local professionals to the table and ask them about their expertise, as well as helping people who are wanting to increase their overall net worth to understand what's going on locally through the folks that I've got here on the podcast. So today it's a little different. I've got someone who's going to discuss a little bit, not only from a local standpoint, but he can share his knowledge from a national perspective on real estate. Lance Lambert is the CEO, co-founder, editor-in-chief of ResiClub, and previously he was the real estate editor of Fortune magazine. Super excited to bring him on the podcast today. I think we're really going to dive into some great content, the graphs and bar graphs and images and so forth that he's able to share with us is just going to be, I think, really educational, but also giving our listeners the idea of, is now a good time to get into real estate? Should I wait? What should I do? So without further ado, I'd like to just quickly introduce Lance and then we'll jump in. Hey, how's it going today, Lance?
Good. Housing. There is always so much going on in the housing market, especially right now.
There is. It's always, with rates and so forth. I think actually just on your LinkedIn, I saw that you copied what Jerome Powell said yesterday in his commentary, and it was interesting. They said, "Listen, hey, we don't necessarily dictate where mortgage rates go." And I think Powell said, "We've got a little bit of a concern about inventory. We still don't have enough." So it's just stuff that I really think people should be aware of because if you're buying real estate long term, I think you can do well, but it doesn't hurt to understand data right now.
Yeah, and I think Jerome Powell's take there is that he believes that there's some level of a housing shortage in the market. And he's saying, hey guys, the Fed can only do so much. And even when the market normalizes and the Fed feels like they can go to neutral with policy and kind of ease up on rates, and inflation's no longer an issue and employment's at full employment, that he still thinks there's going to be this so-called housing shortage in the market. And the other thing that he pointed out to people is that the Fed doesn't set directly long-term rates like mortgage rates. The Fed sets short-term rates. That's what the Fed can set short-term. And that's the effective federal funds rate. It's what banks are lending out on short-term. Now, Jerome Powell also did acknowledge that the Federal Reserve does have some impact there, right?
Yeah.
And if the Fed were to be cutting short-term rates, depending on why that's occurring, that can have an impact on long-term rates. And so if the Fed doesn't directly set long-term rates, how are 30-year fixed mortgage rates set? Well, what it really comes down to is the demand for the underlying mortgage-backed securities. And so how the mortgage market in the US works essentially is that Fannie and Freddie are buying up a lot of these conventional mortgages. They're buying up these mortgages and they then package them into, they're packaged into mortgage-backed securities. And so based on investor demand for those mortgage-backed securities, if there is higher demand for the mortgage-backed securities, so they're buying them up and the prices of those underlying securities are rising, then the yields will go down. So when mortgage-backed security demand is really high, the yields are lower, right? And the 30-year fixed mortgage rate is lower. And so during the pandemic housing boom, or let's just go back even further, during the lockdowns, when the economy was just kind of in tanking, right?
Yeah,
Essentially,
right.
right? There was a huge pullback in economic activity in that brief period. The Federal Reserve started buying up a lot of mortgage-backed security. And so the demand for mortgage-backed securities was very high, but then the yields, because they're inverse, were very low.
Yep.
And so the Fed's buying up a lot of mortgage-backed securities. That drives down mortgage rates even lower, right? And there's also the fact that, during that period of uncertainty, there was a flight to safety, right? And so investors were buying up these securities because they viewed them as safe and they were worried about where the economy was going.
Right.
So rates went very low on the long-term rates. Now, as the Fed stopped buying mortgage-backed securities, what we saw there is that there was a lot less demand for the mortgage-backed securities. So the demand for the mortgage-backed securities went way down because there wasn't a buyer who stepped in to replace the Fed. And so then the 30-year fixed mortgage rate moved up a lot. There's also the fact of greater inflation right? And uncertainty there. And so investors were less keen on the long term rates. And so mortgage rates went up more. Now, the other factor that even pushed mortgage rates up more is that financial markets believed and still believe that people taking on some of these mortgage rates, there's a higher probability that at some point they might refinance down the road,
Yep.
right? So investors are demanding a greater premium and they want a bigger yield to make up for that risk
Yep.
of so-called prepayment risk, right? Where they would refi and that mortgage-backed security gets paid sooner than expected, right? And so that has put additional upward pressure on mortgage rates. And so mortgage rates usually follow very closely with the 10-year treasury yield, right? And so if you go and you Google 10-year treasury yield, it's at like around 4.4, right?
Mm-hmm.
And usually there's about a 1.75 percentage point difference there where, if the 10-year treasury yield is at 4, usually that means that mortgage rates are at like, let's say 5.75, right? Well, the spread, because there has been more of this uncertainty in the market, because there is this prepayment risk and the Fed isn't there as the buyer, that spread is increased. And so right now we're at closer to like a 6.7% 30-year fixed mortgage rate and around a 2.3 percentage point spread. And if tomorrow, if that spread were to entirely compress, the 30-year fixed mortgage rate would be closer to 2.2 versus today's
Yep.
6.7.
Yep.
And over time, the longer the Fed hasn't been a buyer, there's been less uncertainty in the bond market, and some of those things have kind of played out. We've seen that spread compress, and we've seen mortgage rates come off of the cycle high. Now, if the Fed were to start cutting the short-term rate a little bit, that doesn't necessarily mean that the long-term rate's going to come in a lot. But if the Fed started cutting the short-term rate because the economy was weakening, right, and the unemployment was rising, what you would most likely see is some flight to safety in the economy and in financial markets that would pull down mortgage rates faster than expected.
Mm-hmm.
So sorry for the long-winded jumping into mortgage rates, but there's just a lot of moving pieces to mortgage rates. And it's not as simple as the Fed goes out tomorrow, cuts mortgage rates X number of basis points, and then the 30-year fixed mortgage rate falls X number of basis points.
Yeah. Yeah. I mean, that right there was an economic class 101 in about 5 minutes. I mean, anybody that just, paid attention to that, Lance, that is such a good, simple understanding of how mortgage rates work, because I can't tell you how many times I hear, I'm just going to wait until the Fed start to reduce rates, then I'll jump into the market. And no matter how much I tell them, or even, summarize what you say, they just think that the Feds drive most of it. And it's very rare that, just because they increase or decrease, mortgage rates are affected. They can be, but not necessarily as much as people think.
Yeah, it's definitely a deeper, nuanced story. And it's not as intuitive as people hear the headlines, oh, the Fed's cutting rates, the Fed might increase rates, and that X has to happen to mortgage rates. It's much more nuanced than that.
Yeah. Yeah. Well, let's talk about a couple things here locally in Denver. I want to bring up a couple slides here. The first piece that I would like to discuss is active inventory. This is a chart that's created by ResiClub. What does this tell the listener at this point?
Yeah. So if you look at these numbers, what you will see is that active inventory in 2021 and 22 was very low, right? And so what occurred is that during the pandemic, early on, there was a huge increase in housing demand, right? Because unlike the actual stock of housing, how many homes are out there at any given time, demand is much more elastic. And elastic is an economics word meaning it can go up a lot and it can go down a lot.
Mm-hmm.
And so during the pandemic period, it went up a lot and there was a lot more housing demand. And the reason for that was all the stimulus, the ultra low rates made properties cash flow a lot more. So then you had more of the investors. There was all the demand for Airbnbs, right? All of that. And then there's also work from home arbitrage where somebody in San Francisco, Seattle could move to Denver, buy in the deep exurbs, and they could keep that San Francisco, Seattle wage and buy at a lower price than they could in those markets. And so that affordability for them relative brought in more demand for a market like Denver. But
Hmm.
even in the areas that lost people, the people who remained in those places, and this was true in a lot of parts of the country, is that people wanted more space. They wanted that extra office, right? They were working from home more. And so the home became a bigger part of their life, right? And so housing demand for space increased. And plus, you had a lot of like 1 million more household formations than were otherwise expected
Yep.
because a lot of roommates also were like, you know what? I'm used to seeing you 2 hours a day and now I'm seeing you 12 hours a day and I can't stand your guts, right? And so during the pandemic, it was just this anomaly of so much housing demand occurred at once. And when you had all this housing demand that occurred, well, you didn't have the supply there to absorb it, right? And so the Federal Reserve estimates that new home construction housing starts would have needed to increase 300% to absorb all that demand.
Mm.
Well, the thing about housing construction is it can't even go up 100% in 1 year.
Hmm.
Because if you think about it, there's only so many people who know how to do all the things that go into building a home.
Right.
There's only so many supply chains for lumber, for concrete, all these different components, windows, doors, right, that go into a house and the electrical at one given time. And that supply chain and that labor market, and also the entitled land, right?
Hmm.
All
Hmm.
of that only increases at a single digit or a double digit amount. It can't go to a triple digit. So you
Right.
can't even go from 1.4 million housing starts to 2.8. And the Federal Reserve didn't say it needed to go up 100%. They said it needed to go up 300%.
Hmm.
We would have needed to go from 1.4 million housing starts up to almost 6 million to absorb all that demand. It's not possible.
No.
So what happens? And is prices overheated.
Hmm.
And the people who were willing to pay the most were the ones who got to transact. And so a lot of the active inventory in the market, it just got sapped. It got drained, right? The days that it took homes to sell went down. Homes were just flying off the shelf. And so in the Denver metro area, you go from having 6,000 listings in June 2017, June 2018, you had 8,000 in June 2019. And then you were down as low as just barely over 3,000 active homes for
Right.
sale in June 2021.
Uh,
What that math looks like is that for every two homes for sale in the Denver market in pre-pandemic times, you then only had one for sale at the height of the pandemic housing
oh.
boom. So it just halved, right?
Hmm.
And so that demand was just everything that was coming up for sale was just getting bought up fast, right?
Hmm.
So then you go into 2022 and the mortgage rate environment shifts.
Yep.
We go from 3% to 4% to 5% to 6%, and then up to 7% average 30-year fixed mortgage rate. And what occurred is one of the biggest ever affordability shocks on the housing market. And so while mortgage rates were higher in 1981 up to 18%, you had never seen the math shift so quickly as you had in 2022. So it wasn't the most deteriorated housing market, but it was the fastest ever deterioration in housing affordability. And what it also did is then all of that run up in prices that occurred during the pandemic housing boom, that reality manifested into the market,
Hmm.
right?
Hmm.
And so incomes would have needed to increase around 80% to match the increase that happened to housing affordability from prices and from rates. That didn't happen. And so what occurred in the market is that affordability got very constrained. Now, one thing that immediately occurred is that there became some of this lock in effect on the market. And lock in doesn't mean that inventory can't rise, because inventory is kind of that equilibrium of supply and demand. But what occurred with that lock in effect is that the number of new listings coming into the market went down a lot.
Hmm.
And it also put downward momentum on existing home sales, right? There's this chunk of inventory that would normally gotten listed, but when the person who would like to sell their house and buy something else, when a lot of them did the math and they realized, okay, going from X payment, X rate to now Y payment, Y rate, they're like, well, some of them didn't want to stomach that higher payment.
Right.
some of them weren't even eligible for
Hmm.
that next mortgage.
Yep.
And if you do the math, there's around 40% of homeowners in America, and it's actually higher than that, but I just want to give you a conservative estimate, who could not afford to buy their current home at today's prices and today's rates, given their own income.
Really? Wow.
So the market just absorbed this very big affordability shock. Now, unlike the parabolic move up in inventory and deterioration that occurred in '06, '07, this has been a much more steady move up, right? And even though we've seen some of these markets soften a bit and prices roll off the peak, it hasn't been a cascading move down, right? And you even in a market like Denver, you have seen inventory rise, but you're not seeing a lot of distress in the market.
Hmm.
Right now, delinquencies for single family homes, it's still not that high. And
Hmm.
and the reason here is that this story is very different than the '04, '05, '06, '07 period. In this period, there was a big run up in prices because demand just soared very quickly. But the people who are getting into the mortgages, they could afford these mortgages.
Hmm.
They could afford the payments. The credit scores were much higher. Whereas if you go back to the 2000s boom bust, as that cycle was going and that demand was ripping, and there were parts to that story that were similar to this in terms of like the migration boom, right? That
Hmm.
domestic migration boom that occurred in some of these markets. What you had in that story that was unique is that you had a lot of these mortgage products that were accelerating the level of transactions, and a lot of the people who were getting into the homes were getting in with very little equity. They were getting they that you had like the ninja loans where people were
No
buying.
income, no job.
They didn't have the income to support the payment that they had gotten to. You had, essentially that ticking time bomb of the teaser rates.
Hmm.
Whereas today, these mortgage rate buy downs that you're seeing is that people from the get go have to be able to afford what that payment ultimately gets to,
Yep.
right? So
Yep.
it's a bit of a different story. And as that distress built in that cycle, it created, more of that. The forced sellers came into the market, right?
Hmm.
Whereas this story, it's a lot more of affordability has gotten strained too quickly, too fast. Prices ran up too quickly, too fast, and the market is trying to just absorb this, right? And it's taking time, and it's going to take a while for a recalibration and just a market to normalize. And so, as we go through this period where affordability is trying to ease up off of the cycle highs, what we're seeing is active inventory rising. And so, in the Denver market, it's taken time to get going, but as of last June, you were up to 9,000 listings. And then as of this June, you're up to 13,000 listings.
Hmm.
And as that has occurred, it's essentially in a lot of the pockets of the Denver market, it's taken off the board appreciation growth for the
Yep.
time being,
Yep.
right? Prices in a lot of these markets in Denver, if you look through it, aren't really rising. And some pockets are coming down a bit. And I think you'll probably have a chart there. But as that occurs and you see the appreciation kind of flatline or even give up a bit, and then incomes continue to rise, what you have is a healing there for underlying affordability. Because affordability essentially is prices, its rates, and its incomes. And yeah, you could sprinkle in property taxes and insurance, but rates, prices, incomes are essentially the three main affordability levers.
Yeah, and you're absolutely right. I think people also too, they're in their twos, they're in their threes, and they look at moving and they say, well, wait a minute, if I move because home prices have gone up so much, I'm only gaining another bathroom or another bedroom, you know? So why would I want to increase my payment from 2,000 to 5,000 and gain another 50 square feet of home? You know, I mean, it's simple for them to say, I'll just stay put and maybe remodel if it makes that sense that way.
Yeah, and so turnover in the housing market is at around a 40-year low when you adjust for population right now.
Hmm.
And some of that is because, there's some of the strained demand, and so homes are taking a bit longer to sell. But a lot of it's also what you mentioned, that lock-in effect, where people do the math and they're like, you know what? This is a really big payment shock for me to get what? I'm only getting another bathroom. And it's actually possible in this market to sell your house and downsize and end up with a bigger payment,
Yep.
which is just, and if you zoom out historically, this is one of the bigger so-called lock-in effects you can find in US history.
Yeah. Yeah, until we start to see rates come down. But until then, so jumping over to this is maybe just a quicker conversation, but it clearly shows that here in Denver from June of 2019 to June of 2025, we've increased a fair amount. And the graph that you have there, Lance, the brown says, well, those places are actually still below pandemic, but the green, which almost we could maybe argue that it's more of the United States, is above pre-pandemic. Is that how I'm looking at this?
Yeah, nationally, we're almost back to pre-pandemic levels. But a lot of the markets in the Mountain West, a lot of the markets in the Southeast, Southwest, they're back to or above pre-pandemic levels, and now a lot of the West is getting there as well too. The Northeast and Midwest have taken longer to get there. A part of it is because some of these Midwest and Northeast markets, on a relative basis, because they didn't see the same level of home price overheating
Yeah.
over the past decade, they're a little bit more relatively affordable. And in some of these markets in the Midwest, Northeast, investors can still find cash flow. They can still go out, buy a house, and potentially be able to, have make more off the rent than the monthly payment out of the gate. And then there's another factor there too, which is so a lock-in effect, it creates not only a supply shock, but it's also a demand shock in a way. And you're probably like, well, what does that mean? And anybody who is so-called locked in, it means, affected by a so-called lock-in effect, it means that they aren't selling to then buy something else. So that means that they would be a seller and they would be a buyer,
Mhm.
right? But where that shock can occur can be two different places. And so if you're living in Connecticut or New Jersey and you would have sold your house to go buy something in Florida, to go buy something in Texas, well, you are one lost seller, one lost
Mhm.
home coming on the market in Connecticut or New Jersey, but you're one less buyer in Florida or Texas.
Oh,
And so the lock-in effect
yeah.
has created an additional demand shock on some of these domestic migration locations while keeping or taking off some of the supply for some of these places that normally lose people. So that's one reason
Mhm.
too. And then another is that in the markets that have a higher level of single family new construction, you've seen a greater softening recently. And at how home builders work is and how that industry works is essentially a commodity, right? And they make some of their money off of the volume, right? It's
Mhm.
not about just getting the X most dollars out of every home. It's continuing to have a volume, right? You have to have a volume to be able to make money in home building. And as the affordability environment has shifted, builders have been willing to take lower margins, it, and come off the high of the margins that occurred during the pandemic housing boom in order to maintain volume.
Mhm.
Now, you will have some of the builders who are doing less spec inventory in these markets where the unsold completed spec inventory is built up. But generally speaking, the past couple of years, builders in a lot of these markets have tried, especially the big box builders, to maintain some level of volume,
Mhm.
maintain that sales pace. And so to do that in this affordability strained environment, builders have had to do bigger incentives, bigger mortgage rate buydowns, some outright price cuts to continue to move that product. And as they've done these price cuts, these huge incentives, maybe doing, I see a lot of like Lennars out in Colorado, uh, deals that are like 3.99,
Yep.
right?
Yep.
As
2.99 some cases.
2.99.
Yeah.
And as they do that, what it does is it draws the attention of some buyers who would have otherwise went to the resale and existing market.
Yep.
So resale existing in housing means pretty much homes that somebody sells,
Yep.
right? If I list my home, right, that would be a resale or existing home, right? And so it's pulling some of the buyers who would have went to resale and existing, and it's pulling them over to new construction. And so as that occurs in those markets that have a lot more presence of home building, those resale and existing homes take longer to sell because
Mhm.
the resale and existing seller, they're wanting to get every dollar they can, right? They're not a builder. They're
Mhm.
not making their money off the volume.
Right.
They're making their money off that one
Right.
sale, right? And they want to get every dollar. And if they saw that their neighbor sold their house for X dollars, that gets imprinted into their head, and they really want to stick to that number that
Mhm.
they think the home's worth, right? And so they fight it. Whereas the builder, they're more willing to do the affordability adjustments to continue to move that product. And as that occurs, right, the existing and resale market has additional upward pressure. And so this is a very long-winded way to get to the fact that a lot of those Midwest and Northeast markets, they don't have a lot of home building, right? So existing home sellers are really the only game in town in a lot of those markets. And so they've seen less of that additional
Hmm.
softening and
That's
cooling from the new construction.
Yeah, and I would have never really thought about that. Would you also agree that if home prices or incentives in here in Colorado, let's say, are 15% of sales price, aren't they able to make that up in an area where they're not having to give so much concession? So their balance sheet looks healthy to the shareholders?
And so are you essentially alluding to the fact of raising prices as they raise incentives?
I'm just more I want to understand that if like I've seen here in Colorado that some builders are offering a 2.99 buy down, but a fixed rate of 4.99, right? Well, if I was to do that, that might cost my client $30,000, $40,000. So if every builder was having to give a $30,000 to $40,000 incentive across the country, I don't think the home builders would show much profit in their balance sheets.
Well, so a couple things there is some of these bigger incentives have pulled down their margins.
Yeah.
But another part is that during the pandemic housing boom, they achieved the biggest ever gross
Oh,
margins in history.
okay.
So they were coming off of the biggest ever margins that they've had because during the pandemic housing boom, these builders had complete pricing power, right? There were more buyers out on the market than they could sell homes. And
Mhm.
so prices really ran up and overheated and they got these huge margins. So when the pandemic housing boom ends, mortgage rates go up, builders then start to come down off those record margins,
Okay.
take some of that savings, deploy it to the incentives. Now, there has been, and it is possible that some of these incentives aren't always a net effective price cut. And so a net effective price cut is essentially means that the builder is doing a price cut through incentives, right? Where, or it could be outright prices, but a net effective price cut, right? But if the builder is spending $40,000 on incentives, but they have also increased their price another 40,000, it's really just the
I see.
buyers kind of absorbing it.
Absorbing it,
And
yeah.
so in some places, you've had the builders continue to increase prices in 23, 24, and the buyer has kind of absorbed that incentive. And you have seen some people like KB Homes COO warn that, buyers should be a little careful in terms of potentially overpaying
Mhm.
on a home to get that incentive. But it's also true that in some of these places, builders have had to do a bigger affordability adjustment through the bigger incentives, which is a net effective price cut for them. And the buyer hasn't really absorbed it. And it's been the builder's margins that have had to absorb it.
Yeah. Fantastic. Let's go into, we've already kind of talked about it a little bit, but I wanted to just talk briefly about the price. So as you can see here, again, Colorado or Denver Metro, and I think you said the data might be a little bit more updated here soon, but year over year change 2.7. So we are seeing some deceleration in price. Okay, fine. That might take some people off of the fence and say, I'm going to wait. But if you do look at the 5 year change at 28%, that's still a 5.6% increase in appreciation, which isn't bad. I mean, and like you were saying, just because we're going through a little bit of an adjustment doesn't mean that one shouldn't really consider real estate as long as it's long term.
Yeah, that's exactly how I look at it too, Neil, which is we're in this period of some, whatever you want to call it. Maybe it's a bit of a correction, some recalibration, some period of normalization. But what it is the market just got too hot during the
Mhm.
pandemic housing boom, right? Ran up too hot. And we've seen some, softening off of that peak. Denver prices are still 28% higher than they were 5 years ago, right? So this decade, you're already up 28%. And yeah, some prices on a aggregated basis in Denver from the tippity top peak are down 7%,
Hmm. Hmm.
down 2%, 3% year over year, but you're still up a lot on a 5 year basis. And so, I think to some, maybe seeing prices come down a bit, maybe that kind of, is concerning to them, right? But, through another lens, housing historically over the long term drifts upwards,
Hmm.
right?
Hmm.
We'll have some of these periods because housing demand is so elastic where prices can run up too much in too small of a window and then have a bit of a pullback. So, coming off of the peak a bit and having more inventory on the market and more leverage to some buyers, that's also kind of attractive, right?
Yep.
Where they could go into this market and they're not going to be rushed to buy the
Right.
home that they don't want. They can spend time, find what they want, and maybe, if the stars align, might be able to, kind of get a better price than they would have a year ago
Yeah.
or 2 years ago.
Yeah. 5 years ago, everybody was waiving inspection, and now it's like I get more contracts terminated by the buyer, uh, or I should say, by because of the inspection, because the buyer's walking. They have just more homes to go and look at, So that's kind of a big shift of what was and what is today. Um, Kind of wrapping it up here a little bit, Lance, this one I think is important because it's different than days on the market. So maybe just take a few minutes to explain this and how it could affect as we go here in Colorado into a slower time because of weather and fall and winter and so forth, how this might affect prices down the road.
Yeah. So this is median days depending. And median days depending is how many days when a home comes on the market until it's typically pending in a market. And what you really want to do here is look at it. You want to compare a market to its own data, right? For this metric. And you don't want to compare it, you don't want to take days depending and compare it to days on market because days on market could be include days after pending, days until it's closing, right? And so these different days on market, days depending, some of them have different methodologies. And so whenever you're looking at them, what you want to do is you want to do an apples to apples for the same market for the same month. And so what you pulled up here is exactly how I would recommend to look at it. You're looking at Denver, the same metric, all for Mays. And what you will see is that the median days depending is up to 13 for Denver for this metric, well above where it was in May 2021 and a bit above what it was pre-pandemic levels. And so I think what that would tell you is given its recent jump up and that it's higher than pre-pandemic levels at one, active inventory in your market is risen because even if you're not having more homes come on the market, if the days until they're pending rise, right, that'll put upward pressure on active listings, even if more markets aren't coming in because homes take longer to sell, they roll over into the next month. And so when I look at this, I would say one, it's most likely that your inventory is rising. Two, given median days to pending is rising year over year at a noticeable level, that there's been some softening. Buyers have gained some leverage in the market. They can probably go out and find sellers who are having to cut their price, sellers who might even be willing to do some bigger incentives, right? More negotiating power for the buyer. And then, I wouldn't say that's like a parabolic jump up, but it's a noticeable level of softening that's occurred in the market is how I look at the data.
Do you have data, the data, the updated data on June yet?
I could, yeah, I have, yeah, I
I
for
would just be
this.
curious to know if it's even higher than 13.
I haven't cut it yet, but well, the other thing with this data is that there's a seasonal level to it.
Yep.
So like May is going to be one of the lower
Yeah.
ones.
Right.
That like February, April, May, like that window, and later in the year it rises every year.
Yeah.
But yeah, and so another thing that I would tell people out in the market is that especially if you're a buyer in a market where inventory has risen like this, is that when you go into the seasonally softer period, some of these sellers who are motivated sellers, like they have to sell, you're going to have a little more leverage on them, right? Because maybe they listed in the spring, maybe they listed in the peak market and they just didn't get the price they wanted and they've come down a bit. And now they're like, you know what? If they're not delisting it and waiting till next year and they're like, they need to sell, that's when a buyer has more leverage. So I think working with agents who are like out there, understand what's going on, understanding how much leverage a buyer has at any given time. I think those are, negotiating advantages.
So that was kind of the last piece here was a tip for a buyer, which I think you just said. How about a tip for a seller that might be thinking about listing here soon?
Yeah, I think observing what's happening in the market, kind of seeing what is actually transacting in your market, what are the prices that they're going at, how does that compare to recent years, assessing, also knowing from their view that, if you sell into the back half of the year during this seasonally softer period, you might be selling at the weakest part of the year, right?
Mhm.
And do you want to consider delisting and coming back next spring? Or and also talking to, people who understand this market well to see what they're thinking about next spring. Do they think that it'll be
Mhm.
weaker? Is
Mhm.
it better to, to move forward this year? And the other thing is to also know your particular home and that product in that market. Because when you look at this housing market right now, condo has been a lot weaker than single family,
Yep.
right?
Yep.
And I think that's probably true in the Denver market. I need to look at some of the data, but kind of seeing how your particular product type in that area, how it's
Mhm.
faring.
Mhm.
And I'm sure if you look at the data closely enough, there's probably some single family product in some of the better school districts in the Denver area that, haven't seen the softening as
Mhm.
much as we're discussing here.
Mhm.
And so I think just the more information you have, it helps you to be prepared to make the best decision for yourself. And so, I can only give so much advice without knowing all the ins and outs. But I do think if you're working with somebody who kind of understands the ins and outs and can kind of finesse that line of the nuance, I
Yep.
think that puts you in a better position.
Right. I think working with a local professional real estate should really be your best choice as opposed to maybe looking everything up on Chat GPT or internets, the Zillows and so forth. Great segue because this has been fantastic, Lance. I really greatly appreciate you being on. I've been with Resi Club now for I think over a year. I try to read almost every article that you produce because it's just, I'm a little bit of a real estate nerd. And I really think what you provide is such good service. So you don't have to be a professional to be part of Resi Club. I think you can be just an average Joe to really appreciate the content that you're pushing out. Maybe in a few seconds here, tell us a little bit about Resi Club, how somebody can get involved with that.
Yeah, so Resi Club, we are a news and research outlet that focuses on the US housing market. And we're very data driven, charts, maps, trying to visualize and figure out what's happening in the housing market. There is a tremendous amount of nuance to housing. In the stock market, there's around 6,000, 7,000 stocks listed on the American stock exchanges. In housing, and on any given day, those 6,000, 7,000 stocks, you know exactly the market price that they're
Hmm.
transacting
Hmm.
at. Very transparent, right? Whereas in housing, you have, around 100 million plus units in
Right.
the housing market. And yeah, you can find some homes that are, pretty apples to apples with another home. If it's like, a single family home in a subdivision that's very similar, right? But really, at the end of the day, every one of those homes is an individual home, right?
Yep.
It's unique in some
Yep.
way. It's not like, Apple stock or Amazon stock. It's unique and there's a unique story to it. And there's in terms of what's going on in that market, in, that school district, that neighborhood. And so I think what Resi Club really tries to get to is a deeper level of nuance and reporting on the housing market than you've traditionally seen from a lot of these bigger media publications,
Hmm.
where they write a story about just the US housing market, and we're trying to take it a cut deeper. And yeah, there's still a lot of room to get better at Resi Club because there is so much nuance to housing that there's no limit to how much better we can get with the reporting, right?
Hmm.
But what we've already come in and done, I believe, is taken it a step deeper, than what you've seen in a lot of the media publications,
Agreed.
and try to also connect the dots of what is happening in mortgage, what is happening in home building, what is happening in these different segments of housing, and why at any given time can the story vary so much. And also kind of connecting the dots of monetary rates and all of that fun stuff.
So how can somebody, where do they find you?
They can Google ResiClub
Yep.
and just find our website, resiclubanalytics.com. They can put in their email, get signed up for my free newsletter. I also have a premium research newsletter that's a few research articles per week called ResiClub Pro.
Mhm.
People can also find me on Twitter at News Lambert. I'm tweeting nonstop every day.
Yep.
And then also on LinkedIn, just type in Lance Lambert.
Great. Well, Lance, again, thank you so much for taking a few minutes here with us. This has been one of the best. I mean, really, if anybody is looking at real estate as a average Joe, as a professional, I think they have just gotten so much information here that they can really make really good decisions. So, thanks again, and thanks everybody that continues to listen to us. And until next time, we'll have a great day. All right. Thanks.